Okay, good evening, students, colleagues. Thank you for joining our class this evening, where we will be going through Learning Unit 6. Where we will start, we'll initially go through a little bit of theory, so just a quick summary and recap of what Learning Unit 6 is and what the type of adjustments are. And then my colleagues will take you through the revision question as well as then the E-tutor question thereafter. And in between the two, we will give you guys an opportunity to ask questions. So I think you should already be seeing my screen. And if okay, I'll get started right away. Okay, so if we look at the adjustments and what the type of adjustments are that we get, there's about 8 of them. So I'll go through each one in detail and just explain what it is, as well as then just give you what the journal entries are relating to each of these types of adjustments. So the first one is a prepaid expense. So what a prepaid expense is, it's an expense that has been paid in the current financial year, and it relates to a future financial year. What that then means is when recording the information in your books, you should only be looking at the information for the current year. So the portion that relates to the future financial year needs to then be reduced. So what we would do is we would credit the expense. In this case, the example is rent of 2,000 that's paid for the future year, January 20.1. So in order to reduce it out of our current year, we would credit the expense, which would be rent in this case, and we would debit prepaid rent. So that's an example of a prepaid expense. Then if we look at the opposite of a prepaid expense would be an accrued expense. So accrued expense is an expense that relates to the current year. However, it has not been recorded yet in our books. So in this case, we need to actually account for the expense. And similar to the previous example, I've used rent of 2,000 that we are owing for December. So we then need to record it in our books. So we would debit the rent expense and credit accrued rent. That would be how we then record the expense in our current year. Then if we look at the next type of item that we have is consumable inventories on hand. So this would be where we are buying and expensing consumables during the year. And at year end, we still have some inventory that's left over. So that would mean we then need to do a stock count and determine what that inventory value is that is on hand at year end. And we then need to record that as inventory. So how we would do that in this example, it says we have consumables on hand at year end of 500 Rand. So we would debit inventory, which is an asset on your balance sheet, and you would credit consumable expense in your income statement. The next type of expense that we get or item, this is income received in advance. So this is income that we get, and like the word explains, we received it in the current financial year. However, it relates to the future financial year. So we received the income in advance, and that means we need to then move the portion that we received in the current year out of our financial records because it relates to a future year. So in this example, we have interest income, which we received for January 20.1, which is the future year. So here we would debit interest income to reduce the income, and we would credit income received in advance. Okay. Then if we go to the next item, so the next one is accrued income. So that is the opposite of income received in advance. So this is income that we should receive in the current year, but we have not yet received it. So in that case, we need to actually account for it in the current year. So we would credit, in this example, it's commission income. We would credit commission income to record the income, and debit accrued income, which would then be an asset on your balance sheet. The next type is credit losses. So credit losses, usually when you sell on credit, you would have a debtor that you record where it's sold on credit and a debtor owes you money for the sale. What then happens is there is examples where the debt becomes irrecoverable, where the debtor is unable to pay the debt. In that case, it would become a credit loss or bad debt. And that means we would then have to now reverse that data and account for it as a loss, because initially when we recorded it as income and a debtor. Now, because we would not be able to receive that income, we have to write it off as a bad debt. So in that case, it becomes an expense for us. So we debit the credit loss expense and we credit the trade receivable to reduce the asset because we will no longer receive that income. And then the last type of adjustment we have is depreciation. So depreciation is as a result of an asset when a business buys an asset for the use in their business. That examples of those are property, plant, and equipment. So, for example, machinery that you need, vehicles potentially. So, anything to run your business. You buy the asset initially, and over time, the asset value decreases. And that decrease is then accounted for over the useful life of the asset. So usually in an example, it will tell you that, let's say you bought a machine and the write-off period is 10% per annum over the expected useful life. That is then what we record as depreciation, and that would be an expense. So you would debit depreciation expense and credit accumulated depreciation. So that's just a high level, quick overview of what makes up adjustments. And now we'll go into the detail and show you guys a few examples and go through the questions where we then see examples in real life. Okay, so I will hand over to my colleague Tepi to take over. Thank you.
Yeah, I see that there are some hands going up. I think while we wait for Tepi to connect. I'm not sure, Letitia, if you want to take these now or at the end. Okay. Tepi is back.
Yes, if we can maybe keep the questions until we are done with the revision question.
Cool.
Then thanks.
We can't hear you, Tepi.
Seem to be unmuted. I'm not sure why you can't hear me.
Yes, now we can hear you.
Now you can hear me.
Yes.
Okay, great. I was, as I was saying, that I will be taking you through the question, which is part 1. Open the required accounts in the general ledger, and also part 2, which is to record the adjustments and post to the general ledger. And so the first, if you look at the first additional information, we've been given additional information, part A, which says only 11 months of the rental was received. And if you were to perhaps break down this particular requirement, you'd say that you'd have to open the above accounts in your general ledger. So you'd record your accounts in this way. So the accounts, for argument's sake, for the first part of the additional information would be the rental income, and what the account that's going to be See, Letitia is saying she wants to be a presenter again. Should I stop sharing it, Letitia?
No, I think you can continue, MTV.
Okay. All right. So the first part of the additional question is additional information is the part A, which says only 11 months rental was received. So the accounts that will be affected will be the rental income and the accrued income. So when you open your accounts, typically what you would do is that the information that you've been provided with would have the balances that were brought forward. So in this instance, you have a balance brought forward of 6,600, or rather a balance brought down of about 6,600. And that is the information that we would have received and that we would have been provided with from the information. And then when you do your second part would be to I don't know to get into the part, but the part 2 as yet, because that's when you record and then you do the necessary adjustments. I just want to take you through the actual control accounts that we're busy with. So it seems to be stuck. And then the second part would be to record the stationery on the stationery account. Something with my presentation because it's not moving. I seem to be stuck here. Just try something else.
But the dessert would absolutely die for, and for that, I'm giving you a 7. Yeah, well, thank you for tonight. The hair was problematic. It will start at handmade for me. Your dessert is absolutely delicious. I think you would have paid a little bit more attention to us, but for that reason, I'm going to score you a 5.
I'm sorry about that. There's a bit of a technical glitches I'm experiencing here. Can I ask my fellow e-tutors to project for me, please, because I seem to be having problems.
Sure. I will project.
Please project, because I seem to be having technical issues with projecting.
Okay, which you tell me when to stop. Which
Go right up to the I think it would be the third slide, the third or the fourth slide. Yeah, I was here.
What?
Yeah, thanks. Sure. Yeah, I was here. Thank you. So the information we've been provided with. We've been provided with this information, and we are required to open the above accounts in the general ledger. So typically, what would happen is that you would just record you would open your accounts on your in the general ledger. So your balance brought forward as per the additional information that we've been provided for was the 6,600 that we got from the additional information that is directly from the revision question. Go to the next slide, Sandra. Next slide.
Start moving. Yes, not moving.
The next slide. Okay, the second general ledger account would be the one that relates to stationery on hand, which is on stationery on hand on the 30th of June 20.2, which amounted to 50 Rand. However, we're not going to deal with that right now, but we'll deal with the part one of the question, which says open the above accounts in the general ledger. So if you refer to your information that you received, you had stationery to the value of about 350, which when you open the account, which is this balance brought down. So you have the 350 there, and that is what you have been provided with. Go to the next slide for me, please. So typically the accounts that would be affected would be the stationery and the consumables inventory on hand. I've just reflected them in the slide, in one slide, because when you do the second part of the question, that's when we'll do the recording of the adjustments and post to the general ledger. Okay, go to the next slide for me. Thank you. The third one would then be the commission income account, and the balance brought forward would have been the 5,600 as reflected on here. or rather the balance brought down, which is the 5,600. That is the information that we've already been provided directly from the question. So when you go to the second part of the question, which is the part 2, where you record the adjustments and post to the general ledger accounts, that's when you do the necessary adjustments. So for now, it's just to show that to carry literally open up everything and open the above accounts in the general ledger. Go to the next slide for me, please. Okay. So the next one would be the credit losses, which is the bad debts, which is, if you look at the additional information that we've received, you said the an additional amount of 150 must be written off as irrecoverable. And the type of accounts that would be affected would be the credit losses, or also known as bad debts, or trade receivables control account. Go to the next slide, thank you. And then the part E of the additional question, the additional information related to the provision must be made for depreciation of 30,000. That's just literally the information that we have been provided, been given from the additional information. And we just recording the part 1 of the question, which is to open the above accounts in the general ledger. Go to the next slide for me. Next slide again. Okay. The same thing is the same thing continues, which is the water and electricity account. Part F, or from the additional information, where they say the June 20.2.2 water and electricity account of 160 has not yet been paid. But since you're dealing with part A of the required, which is to open the above accounts in the general ledger, so you just literally carrying or opening the ledger account with your balance brought forward of 1,800 on your debit side. Okay, now we deal with the part 2 of the required. Can you go to the slide number? I think it was slide number. Oh, that's just an additional information from the profit and loss account, which is an extract. Now you deal with the part 2, which says record the adjustments and post to the general ledger account. As you recall, the additional information indicated that part A says only 11 months worth of rental was received for the account. And as I had indicated, that the account that would be affected would be accrued income, and then you credit rental income. So when you go back to your general ledger account, can you go back to the general ledger account for Mrs. Sander? I just want to show how you would record it.
It's fine.
It's part A. It
Part
will
A.
be A. Yeah. Yes, thanks. So if you remember that you opened the account with 6,600, which is the balance brought down of 6,600. And then because the additional information that we've been provided says that only 11 months of the rental was received. So you then would then raise a debt. It's like you're raising a debt for a rental income, which would be when we did the general the adjustment is that you then credited your accrued income with the 600,000. I mean the 600 that you received, which then gave you the contra, which also will affect the contra account of the accrued income. So the general journal would then be you will debit your accrued income and then you'll credit your rental income. Go to the next slide for me. Okay, so stationery on hand, the additional, the part B of the stationery on hand on the 3rd of June, you had a stationery on hand, which amounted to 50 Rand. And this transaction, when we analyze it, it affected two accounts. It affected stationery and it also affected consumable inventory on hand. So when you started with a 350, which was your balance brought down. And then you then had a 50 Rand, according to the additional information that we've been provided, that the stationery on hand, we had about 50 Rand that was still within the books or with our books. So therefore, this 50 Rand will then be a credit in our books. So when you balance out your account, you'll have your stationery, and it will affect also the consumable inventory on hand. Can you go to the next slide for me? Okay, the other account is, or the next account is commission income. According to the additional information, can you just click on the part that yeah, we've got commission. We've got about 600 commission was received in advance, and in this instance, the commission was received in advance. And it will affect two accounts, meaning it will affect the commission income, and it will also affect the income received in advance. Hence, when you see the two general ledger accounts, that you will have the 600, which obviously would be a debit for the 600. And then your income received in advance will also be the contra account for the commission that you received in advance. Go to the next slide for me. An additional amount of 150 must be written off as irrecoverable. In this instance, the type of accounts that would be affected would be the credit losses, which is the bad debts, and it will also affect the trade receivable control account. As you recall that you opened your account with the balance brought down of 280, and then in the additional information above, you've been told that an additional amount of 150 must be written off as irrecoverable, meaning this particularly would mean that this amount will not be able to be recovered. So the 150 will then be a debit onto your credit losses, and it will also affect your trade receivables control account on your credit side. because it will reduce your creditors control account. Remember, trade receivable control account is an asset, and it decreases on the credit side. So hence you see the control account here of this 150. The 150. The 150. Go to the next slide for me. Continue clicking. Okay, the section E of the provision must be made for depreciation of 30,000. This particular transaction is going to affect two types of accounts. It will affect your machinery. It will also affect your accumulated depreciation. Hence, we have the general ledger account of the accumulated depreciation on the machinery, and we also have the general ledger of the machinery at cost. Click again, please, Susanna. So in this instance, you're making a provision for depreciation, which was provided in the additional information that you should make provision for depreciation. So your account would then be a debit depreciation. You debit your depreciation and you debit your accumulated depreciation. Go to the next slide. Okay, the additional information provided that June 2020 water and electricity account of 160 had not been paid. In this instance, your water and electricity, or rather the transaction will affect the water and electricity, and it will also affect the accrued expenses. This 160 that you see here, it had not been paid. You started with your balance of 1,800, and now you need to provide for the 160 of this that was not yet paid. So you will then debit your water and electricity account, which it is an expense, and then you also credit your accrued expenses of 160. Hence, you see that the general ledger is reflected as above, that you can see that it affects two accounts. It affects your water and electricity, and it also affects your accrued expenses. Okay, go to the next slide. And then this is just the effect of the transactions as they've been presented on part two. Yeah, that's just it's just an extract of what it will affect in terms of the profit and loss account. Yeah, thanks. I'll hand over to Sandra.
Sure. Thank you. Am I audible? No. Yes, I'm audible.
Yes.
Okay. Am I audible? Can someone confirm?
Yes, you are.
Yes.
Thank you. All right, now going on to part 3, right? So part 3 asked us to now record the closing journals and show the profit or loss account in the ledger, right? So now this is pretty much where, or the easier part of the question, right? Because you've done all your hard work, where you've determined, let me put a pointer here, where you've basically determined what your accrued rental income is. And by the way, so this would typically only have an impact on your accounts which are going to be your profit and loss accounts or your income statements accounts. Any accounts which will affect your balance sheet will not be part of your profit and loss accounting ledger closing entries, right? So once you then have your total, so in this case, if you look at rental income, if you add up what the balance was, what the balance was, together with what the accrued income, as my colleague mentioned, you then get a total of 7.2, right? And then now to close off this account to your profit and loss, we need to debit this account to the profit and loss account by the same value, which will then equate us basically closing off this account to a zero. And this is typically happen at the end of the financial year. So that when you start the next financial year, you would have no balances which will relate to your nominal accounts or your income statement accounts. Same principle would then apply to your commission income. Here again, as we discussed, so there it is a credit, a balance, right? Because it reflects income. So there we had a 5.6 balance that we had brought in as at the end of June, right? And our adjusting entries was whereby we had to take out the portion which related to the income received in advance, which related to the next financial year, right? And then the closing of this account to balance it off, we need to get to this 5.6, which then results in this 5,000 rand being what we then close off to our profit and loss account, right? And then going on to your stationary expense account. Here again, as we discussed, so here we had the balance which was brought forward as at the end of June of 250. Then we discussed that we had a balance to be carried over to the next month or to the next financial year of 50, which we then take out to our balance sheet account, which then results in our expense, which we need to close off to our profit and loss account, being 200 Rand, which is then what we would post to our profit and loss account. All right, then going on to our other sets of nominal accounts or income statement accounts. We had the water and electricity expense account, where there we had the balance of 1.8. There we had an additional expense of 160 Rand, which we need to take into account. Therefore, when we close off this account, we close it off at that 1960, right? I think there was an error in the solution. That 50 Rand should not be there, because if you look at that, then the 1960 is what gets closed out to our profit and loss account. Credit losses account, which is also known as the bad debts account, same again, whereby we had a balance which was brought forward of 280. There, as we learned, we had an additional amount of 150, which was written off, which then resulted in our expense for the period being 430. And then that is what we also write off to our profit and loss account. So when you square it up, that's the 430 which we would have. And then the last one being our depreciation account. So there, as we had there for the current year, the depreciation expense was the 30,000 Rand, which was given in our question. So for that balance as well, in order for us to clear this account for the current financial year, we also need to write it off to our profit and loss account, which resulting being that 30,000 Rand. All right, and then looking at just at the profit and loss account, right? Because for each debit, you'll have a credit, right? So looking at our profit and loss account, we would basically have a debit of the 300 Rand. If you go back a few slides back, should be just quickly to show where that comes from. Nope. There, right? That 300 Rand there, which is what we're basing our post to the contra entry being our profit loss account. So all these entries will then also have their own contra accounts in the profit and loss account, and that is what we would see in this last or in this last slide, having stationery, water electricity, credit losses, and the depreciation account. As you will see that all the expenses basically would appear on the debit side of the profit and loss account, and then on the credit side you will get all your income related accounts, being the rental income as well as the commission income of 5,000 Rand. Again, all contra entries as per our nominal accounts that we went through. And then looking at now at how this would basically impact your general journal. We basically are closing out the income accounts. So in order for us to close it out, we need to debit rental income, debit commission income. So where we would have basically cleared then this account to the profit and loss account. So these accounts at the beginning of the next year would have come to 0, which is what we want to see, right? Because these are all your income statement or your profit and loss related accounts. And then looking at your expense accounts. So these would all fall on your credit side, right? Being your stationery, your water, electricity, your credit losses, as well as your depreciation. And then we'd also then debit that account, as we've seen in our T accounts, be going to your profit and loss account. That just being a total of all of these expense accounts, which then make up this 32,690. Yeah, so then we have basically have completed our part 3 of the question. I'll then hand over to my colleague, Sihle, for section 4 and 5. Sihle, I hope you are online.
Thank you very much, Sisanda. Good afternoon, colleagues. Let me just fly it in.
Yeah, I'll stop sharing, Sihle.
Okay. So let me just
Do you want me to continue sharing, Sihle? Well, you.
I just want to double check. Is it showing there on your site now?
No,
My presentation.
No, we currently can't see anything.
Okay. Let me just start again. I think maybe Sisanda, if you can just assist me in just projecting the slide, I think it will work.
Sure.
Because I'm just struggling here. I'm just trying to.
No problem. Okay, I am sharing.
Okay, no problem.
Confirm that you can see it.
Okay, at the moment it's not showing on my side.
Can anyone else see the presentation?
Other colleagues, can you confirm whether you can able to see the presentation?
Yes, we can.
I don't know what's going on my machine. But I must just join with the phone, but that won't be working because I was just trying to. Because I don't see it on my side. So I don't know what I must like rejoin or what. Because I don't see anything on my side on the screen. Let me just maybe move the screen to the side and change maybe the connection.
Or perhaps if you can speak to slide 20, and then
Yes.
just let me know when to go on to the next slide. Assuming you've got a copy on your side that you can see.
Okay, no problem. I think maybe if you can just go straight to that slide where it's got a required
Yes.
on the exercise 6.5. Yes. So
Yeah.
basically, it's apologies, colleagues. Good evening. Apologies for the delay. I was just trying to fly it and I have some challenges, but I'll speak to the slide and then my colleague Sandra will be able to assist in terms of moving the slide. So from this slide, colleagues, basically it's just a sort of a recap of what Sandra as well as the other colleagues that have presented for the adjustment that were done. But the required on this information, especially for section 4, we are required to prepare an extract of the statement of financial position, obviously taking into account the adjustment that are mentioned on the question, which is on additional information. I just wanted to run through all those items so that when we are on the solution, we are all together. So one item, which is item number A, it's relating to indicating that only 11 months rental that was received. So obviously, you've already seen the amount of 6,600 on that extract information above. So what you need to do, if you just take that 6,600 to divide it by 11, now you know that the monthly rental, it's actually 600. So obviously, since they paid on 11 months, it means there's an accrued income of 600 rand, which is a kind of a debt that will be added to get on your debtors control account. Then when you go down on the additional information, they just highlight to that there was a stationery on hand. I think one of the points that were mentioned by Letitia to say at the end of the year, the company makes the inventory count. So obviously in this situation, the stationery that was on hand on the 30th June 2022, it amounted to 50 rand, which means obviously this amount you're also going to show it on your face of the statement of financial position. And then when you go down on item number C, you are told that 600 commission was received in advance. So like what Letitia indicated, that obviously that means now the rent, the commission for the full 12 months, that means it's received, which means the 600 is for the future period, which means therefore these people, we are kind of like we are owing them. It's like a temporary liability. So we want to show it also on the statement of financial position under current liabilities. Then when you go down to another one, I think one Sandra was also covering to indicate that in the past we used to call them bad debts. So obviously, initially you were told that there was a debt credit loss that was done, but however, there is additional of 150. So which means now this one you also need to take into account, which means from your receivable that you already shown there, you also need to take into account and adjust with another 150. But I'll also show it when you're going to the solution. I'm just going to run quickly so that we can also give you guys time so that you can be able to ask the question. And then section E, which is relating to depreciation. Obviously, you are told that the depreciation for the year is 30,000. Obviously, as what Sasanda was taking you through the entries, you debit depreciation, you credit accumulated depreciation. So obviously, we all know that the asset that we have there on that extract, they are costing 200,000. And also, you see in there that obviously in the previous year, there's already accumulated depreciation of 30,000. So obviously, you have to take into account the state, which obviously in total, now you're going to have a total of accumulated of 60,000, but I'll also show it. Now, on the last point, which is F, we are also told that for water and electricity, an amount of 160 has not been paid, which is an accrued expense. It's a temporary liabilities. So basically, 1 month maybe has not been paid, similar to what you see on action item number 8. Now, listen, Susan, you can move on to the solution.
Yes, I'm on slide 21 now.
Yes, let me just go there. Yes, on the slide number 21. So on this one, colleagues, as you can see, that now this is a phase or the extract of the statement of financial position. As I was just taking you back, doing the recap on those adjustments. So obviously now when you are starting preparing the financial statement, obviously this is the phase where those items that you need to show. So the first part, obviously, we have to put the item for assets. Obviously, we know that assets they're categorized into two. One is for non-current asset, the other one is for current asset. So from under current asset, obviously, we do have a property, plant, and equipment, as I indicated, that we've got it, and obviously, it cost the business 200,000. And obviously, we have to also take into account by deducting the accumulated depreciation, which is the 30,000 that you've seen, which was for the previous year, plus that one of 30,000 that Susanda was highlighting when he was showing you the entry. So obviously, 30 plus 30 obviously gives you 60. So as we know that in terms of preparation of financial statement, all assets must be showed at net carrying amount. So obviously, this is the gross amount, which is 200,000, minus total accumulated, which is 60,000. That gives us the 140,000. Now, when you go down to the current asset, as I indicated, that stationery, which is inverted, that was on hand, which we were told that is 50 rand. So we just disclose it on the face as it is there. And then also take into account on your trade receivable, as much as there was that credit loss that was already been taken into account, but however, you are told on the additional information that there was another credit loss of 150 that must also be considered. So from the 11,150, you must also deduct 150. And then after that, you add the 600 rand, which I indicated that it's relating to the rental amount, where it was paid 11 months, and then there's an accrued one, which is where they are owing us 600 rand. So when you add these two, which is going to give you 11 plus 600, it's give you 11,600. Now, when we go down to liabilities, and also, we've got non-current liabilities and current liabilities, but in this situation, based on the adjustment, the digital information, we've got one which is relating to trade and other payable. Obviously, one of it is one where we highlighted that there was accrued expense for water and electricity, where 160 amount was not paid. So that amount, we show it here as it is, as it's shown on that additional information there. And then after that, below that, you are told that there was a commission that was received in advance, which amounts to 600. As you know, because those people who are owing, we cannot say it's belonging to us. So in that case, we put it as the current liabilities as 600. So the total will make it like 760. Thank you very much, Susanda, in that regard. You'll assist me to hand it over to, I don't know whether it's Nosihle that is going to present after this. Thank you.
Thank you. I would be sharing my slides. Can everyone see them? I'm sharing.
Yes, we can.
Oh, okay. Hi everyone. So for now, we will be doing the last question under exercise 6.5. So how we'll do this, we'll start with the structure, because the required, it's actually asking us to show the property, plant and equipment node. This is the required number 5. So how we going to do this? We're going to talk about the structure, and then we're going to go to the question to see if we can identify any property, plant and equipment there, and then we're going to look at the solution. Okay. So we are starting now. So this is the structure for property, plant and equipment. So you can have your land, you can have your buildings, you can have machinery, you can have your vehicles. So for that, and then you have to have the carrying amount at the beginning of the period, and then you have to have your cost, the accumulated depreciation. And then there you also have to have, okay, the cost, you have to add it. And then your accumulated depreciation, on the other hand, you deducting it actually. And then with your depreciation, And then you're going to have depreciation for the current period. And then that depreciation, because it reduces the value of your asset, you have to deduct it. And then even with like impairments, like impairment, let's say your asset is damaged. So even that one, it's reducing the value of your asset in some way. So it has to be deducted. And then you'll also have like, let's say you're buying a new asset, like let's say you're buying a new machinery, so you'll have additions, and then your additions have to be at cost, so they're increasing the value of your asset, so that is why you adding it. And then disposals, you had a vehicle, so now you're deciding to sell it, so you no longer have it, so you have to reduce your books to indicate that you no longer have that particular vehicle. And then so even then you have to have the carrying amount at the end of the period, so the same thing, the cost, and then you accumulated depreciation, so you adding that depreciation as well. Okay, so now we are going to, because the question is asking us to show the property, plant, and equipment note. And then we are then going to go to the actual question to identify if we can see, sorry, just want to go to the question, it's faster this way. So this is the revision question. So they've given us this. The balance is at 30 June 2006. And then, so we have rental income. It doesn't form part. Stationary, water, commission doesn't form part of PPE. Oh, and then we have the accumulated depreciation for machinery. This is what we're looking for. And then we have the trade receivable controls, no. And then we have machinery at cost. So for now, we identifying the 30,000 and then also the machinery at cost, which is the 200,000. So we have the 200 and then the 30,000. And then under additional information, this does not relate to property, plant, and equipment. Even that one, commission, no. Additional, no. But we have the depreciation of 30,000 on machinery. So we have, so we actually have the items that relate to the property, plant, and equipment note. It's the machinery at cost, which is the 200,000. We have the accumulated depreciation, which is the 30,000, and then the depreciation for the current year as indicated. So now we're going to move over to okay. So we saw like on the question, and then even on the additional information that we were given. So the only property, plant, and equipment is the machinery in this case. So we are given the cost of 200,000. We got it from the question, and then the accumulated depreciation. So it's the beginning of the year. So it's the cost, which is 200,000, and then accumulated depreciation, which is the 30. And then so when you're saying 200 minus the 30, that's how you're getting the 170. And then they've also given us the depreciation for the current period. Then we know depreciation reduces the value of your asset. So depreciation and then the 30, so it also has to be included there. So at the end of the period, we know that, okay, so the carrying amount at the end of the period, so we have the cost. The cost is not changing, the 200,000. And then we have the accumulated depreciation of 60. So we taking the accumulated depreciation at the beginning of the year, and then we are adding the depreciation for the current period to give us the 60. That is how we ending up with the 140, because like now our our machinery, the carrying value is at 140. So if you go back to this, it's the same thing. You follow the structure, you are sorted for life. Okay, thank you. That is all. And then now we will be taking questions for the revision exercise 6.5.
Yes, I think perhaps let's start off with I'm seeing hands have been raised. The chat thing is still closed. Yeah, let's allow the first person, Team Mapudi. Apologies if I don't pronounce your name or surname correctly. Mapudi, please unmute yourself and ask your question. Are they able to unmute themselves? Joseph? Joseph, can you hear me? Or can we unmute them? Guys, am I audible?
You
Yes, you
are.
Yes,
but
you
I don't-
are.
We don't think we can unmute ourselves.
Yeah, I don't think they can unmute themselves.
They can unmute themselves. Hutatso, can you speak?
You can allow them. You can.
Yeah, I
them.
allowed. I enabled Hutatso. So please unmute yourself and speak.
No, what I'm saying, you can, as E-tutors, you can allow the mic.
Yes, I allowed the mic for what, so I'm doing it one by one.
Oh, yeah, thank you.
Yes. Okay, Kotatsu seems to not be there. K Lifenya. Happening.
I'm also trying to unmute them, but it doesn't look like it's working.
Yeah, because usually if you unmute them, then they can unmute themselves. And okay, let's see the others. Duduzi, Derek Puma.
Lola, am I audible?
Yes, you are.
I just wanted to ask about the profit and loss account. How do we do the profit and loss account? And I saw also on the general ledger, you added the profit and loss on the credit side, and also on some accounts you added them on the debit side.
Okay. Should we
Sure.
take another question?
Okay.
Then El Selega. Okay, hand is down. S Sidumedi. S Sidumedi, we can't hear you. I can see you're talking.
Lola, am I audible?
Duduzi.
Yes, I asked the question, no one responded.
Yeah, no, we just want to take another question, then they will respond to your question.
Okay, no problem.
You I'm not sure. As Sidumedi, maybe just check your mic. So long. Then Kamkhelo Sibe. Okay, guys, please, when you raise your hand and let it stay up if you want to ask a question. Don't raise your hand, then drop it when I call out your name. Please, then Tato Bole. Okay.
Hello, evening.
Hi, Tato.
Yes.
Hi, how are you?
Good on you.
I'm good. I'm having an issue, so I don't know if it was just from my side or what. But then while Mrs. was it Tepiso, yes, while she was busy explaining the general ledger profit and loss, we couldn't see the slides and everything. So I don't know if or maybe I was the only one who was having problems or what. But then she was just explaining, and then we couldn't see the slides.
Okay, so I think apologies for that.
Yes.
Yeah, so do you have a specific question on the explanation that she provided, or will you be able to follow once we share the slides at the end of the class?
I think I'll be able to do that.
Okay. So the slides will be shared with the recording for you to be able to then follow through.
Okay.
Okay, great. Thanks, Tato.
Bye.
Then shares.
Hi everyone, can you hear me?
Yes.
Yes.
Cool. I wanted to ask, well, I'm not sure if it's gonna be like a valid question because I was a bit lost. There was a point where you were talking about adding accumulated depreciation, and I think it was my network, so I couldn't follow properly on what you were saying. I don't know if it's possible for you to repeat that part for me.
Thanks, shares. Maybe let's take those two questions, then we'll take the rest.
All right, cool. So then let me address the first one. Perhaps I'll reshare again the start, maybe to be easy to explain. Okay. Yeah, my screen is visible, right?
Yes.
All right. Okay. So question was, how do we get to, or how do we know where to book a profit and loss account, right? So just to reiterate, right? So the profit and loss account will only impact your accounts, which are your nominal accounts, or your account which will impact your profit and loss account, or your income statement accounts, which will typically be your expenses and your income, right? If you look at this first one here, sorry, it's more bigger. If you look at this, the rental income account, right? Because it's an income account, the balance grows on the credit side, right? That's why the balance brought down is on the credit side. Then in the question, we had an adjustment whereby we had to accrue for an additional month. So we were adding to the income, which then resulted in us adding the 600 Rand to the 6.6, right? And then now when we want to close off this account at the end of the financial year, right, we can't go and credit this account because we will be increasing it. When we close it off, we basically want to square it off to being 0, right? And we square it off to the profit and loss account as a closing transfer journal entries, right? And so in order for us to do that, we need to clear the full balance, which will be the 6.6 plus the 600 Rand, which will give us the 7,200 Rand, right? So that's typically what you would do for your an income related account, rental income, any sort of income account, as well as we also followed the same approach for your commission income, whereby the balance is on the credit side, and then there was an adjustment that needed us to reduce this, right, because of the income received in advance. So in order for us to square up this account to 5.6, we then needed to debit this account by the 5,000 Rand, right? And then if you look at a typical expense account, if you look at the stationary expense account, so here we had the balance. So because it's an expense account, it will grow or increase on the debit side, right? And then we're told in the question that we had stationery on hand to be used in the next financial year of 50 Rand. So this is what we then had to adjust out for. And then what was left in this account in order for us to square off this account was the 300 Rand, which is then what we then took to our profit and loss account. Right, if I go now to the last part, so the profit and loss account. So this is just the contra entry to all those accounts, all the entries that we were booking in order for us to square off the expense accounts as well as the income accounts. So then you end up basically having all the debits in the profit and loss account, and you would show the credits the same way that you would here. These is just simply the contra account of the entries that you would have booked, right? And then closing of these accounts, you debit, right? Debit the income accounts because now you're trying to clear these accounts for all the income that you have recognized for the current financial year, and you clear it off by debiting these accounts, and then you credit the profit and loss account. And the same principle would then apply for your expenses, but now just the other way, because now your expenses would typically be a debit balance. In order for us to close them off, we would have to credit those expense accounts and then debit the profit and loss account. I hope that helps.
Thanks, Sandra. Then the other question,
Yes,
I
think that one was for me on the Mshazi on the accumulated depreciation being added. Okay, so for that one, with accumulated depreciation, let's say your year end is 31st of December 2024, and then you are buying an asset, you bought an asset for 200,000. You bought an asset on the 31st of December 2024. So if that's the case, you're not going to have accumulated depreciation because you just bought it. So what is actually the accumulated depreciation? It is the depreciation from the previous years, and you have to add even the current year's depreciation. So it is the previous year, and then you add the depreciation, and then you'll have, because it has to reduce the value of your asset. I'm not sure if it's making sense as to why we are actually adding it. Mshazi. I think we can take another question. Yeah.
Great. So if Mshazi, you're not clear, please indicate on the chat what are you not clear on so that we can address your question in full. Nmuatse, are you up? Please unmute yourself and ask your question. Okay.
Sorry,
yes.
my mic was disabled. Can you hear me?
Yes, we can hear you.
Okay, thank you. I understand the part of closing off the accounts, right? whereby we have to, for example, to close off the account for rent income, we have to close it to profit and loss. But my question is, do we also, on the profit and loss account, do we also add the trade receivable account to the contra account?
Thank you for your question. Then can we take S. Makunyane?
Hi, everyone.
Yes.
Hello, can you hear
Yes.
me?
Yes, we can hear you.
Yes, I just want to find out if we're going to have this recording on the website. And another thing, we were given a number for a tutor, but when we contacted the tutors, I don't know what other we can get for the tutors.
Okay, I lost you a bit there, but yes, the recording will be available on the module site, together with the slides. I just missed your question on the tutor, but if you want to reach out to your tutor, please go to your E-tutor site and please leave a message for your tutor. They should be able to get back to you with any issues or questions that you might have. I'm not sure if that covers you, but let's respond to Enwats's question, please.
Okay, let me take that one as well. So yeah, so because the accounts receivable account or control account is a balance sheet account, so that will not be closed off to the profit and loss. Remember, we only will close off accounts which are related to your statement or your statement of profit and loss account, not any balance sheet related accounts. So that's why we do not close off your accrued income, your property, plant, and equipment. Those were all not closed off because those are all your balance sheet accounts.
Thanks, Sisanda. I think Enwatsi, you can state on the chat if there's something that Sisanda still needs to clarify. I think now I see all the questions have been addressed. If you have any further questions, we'll open the chat again for you to include your questions. But yeah, now we want to now cover the E-tutor question, and I will be taking you through that one. So I just want to share my screen.
Just to say something quickly there, I think it would be very nice if you guys could actually do these accounts while we are watching live in real time, because it's one thing to watch slides and it's another completely thing to watch you actually do it, so that we can maybe just take notes. I don't know if I'm making sense. So it would be nice to actually see you guys do the actual transaction.
Okay, great. No, thanks for the input. I think we will consider it for the upcoming classes that we will be holding. Thanks. Okay, please confirm if you can see my screen.
Yes.
Yes.
Yes, we can see.
So I'll be covering the E-tutor question. This E-tutor question was covered in March, but we just want, for the purposes of revision, to just cover it one more time. This question, unlike the previous question, the revision question, is not so detailed. We'll be covering about 11 adjustments. So just for the principles, for you to understand, and these are the 11 adjustments that we will be covering. I'll cover the first 5 adjustments, and then the next E-tutor will then cover the remaining transactions. So in terms of the first adjustment. This related to packaging material that was on hand to the value of 980. So if we look again at the principle that Letitia covered in terms of inventory or anything that is on hand, she indicated that these are all expenses that are, this is the inventory that has been not brought to sale, but for the use of the process of earning the income. And one of the examples was packaging material. So because now there'll be physical inventory that is left at the end of the financial year that can be counted, a closing amount should then be determined. So for you to then deal with this, the journal entry that you would need to pass would be for you to debit the inventory. So you now increasing our inventory because it's an asset that increases on the debit side, and then you would credit the packaging material with an amount of 980. Then the second transaction is where a long-term borrowing was entered into on the 1st of October 2001. According to the agreement, interest is payable biannually at the rate of 18% per annum. The long-term borrowing amounted to 25,000 Rand. So in this case, we need to then accrue for the interest because we would have not paid for the interest at the end of the year. So we need to then accrue for the interest. So what will then happen is that for us to get to the interest, we need to make the calculation where we need to take the amount which we have borrowed, which is the 25,000, determine it at the interest rate of 18% per annum. Because now there's only 3 months up until the year end, which is October to December, we need to then apportion it and determine for the 3 months, which will then amount to 1,125. With that one, 1,125, because now we need to then create the journal, we will need to then debit the interest expense because that interest expense would need to be paid, and then would need to then accrue for this expense that we are recording and credit accrued expense with the same amount. Then the next one would be an advertisement, which includes an amount of 400 that will be paid in the it's paid for next year. So the advertisement will only take place in January 2002. So in this case, the type of adjustment that we're seeing is a prepaid expense. In terms of prepaid expense, we will then have to debit prepaid expense, which is a sort of like we're decreasing the liabilities that we have paid, that we have because now this amount has been paid for in advance. Then we will then credit our advertisement expenditure, which is with the 400 Rand. Then the next one is where we have a rental income, which includes an amount in respect amount of 15,600, which is for January 2002. So because now this is the income that we've received that relates to the next year, we regard this adjustment as income received in advance, where we need to then see, because it's just for January, we need to look and calculate from the total rental, how much is the rental for January. So what we'll do is we will take the 15,600 and determine the rental for the 1 month, which is now 1,200, which will now result in an adjustment where we will now debit our rental income, where because that income cannot be recognized because it's not our income in the current year. So we're now decreasing our income, and then we will credit our income received in advance with an amount of 1,200. Then the next one is where there's interest on the fixed deposit that has not yet been received for the last 2 months. of the financial year. This is for a fixed deposit of 50,000 Rand, which had the interest is calculated at a rate of 12% per annum. So because we have not, the bank has not given us this interest, what we need to do, we need to then do an adjustment which will create an accrued income. We will need to then determine, because it's for the last 2 months of the financial year, how much that interest income that we need to accrue for will be in this case. So what will then happen is that you'll take the fixed deposit amount that is in the bank account. You will then determine the interest at the rate of 12% that you're getting from the bank. And then you'll then determine how much interest is it for the 2 of the 12 months of the year, which have not yet been received. That will result in an accrued income of 1,000 Rand, meaning that now the journal entry that we need to pass is that we need to then debit our accrued income, because this is the income that we will receive, and then we'll then credit where we're increasing our interest in investment with the same amount. I'm going to hand over to Kuto to then take over with the remaining adjustments. Thank you.
Good evening, everyone. My name is Kuto, and I'll be taking you through the last slides. So just to incorporate the comment that was given, I am going to ask that we, like the people in the group, the students be given the opportunity to the chat box so that they can give their opinions instead of us going through the slides. I hope it goes well. So yeah, just not prepared. We're preparing to go through the slides, but then just to involve the students so that they also partake or do that. So I will be going through from 2.6. So 2.6 says insurance includes an amount of 750 paid for the period from 1 November 2001 to 31 October 2020, 2002, right? So from the question, basically what it's saying is that because if we look at see this presenting. Okay, the first slide. If we look at here's our insurance, the total, our year end is 31 December 2021, right? 2001, right? So our insurance includes the current year portion, which is November to December, and then last 10 months. So can someone just write in the chat box on how we would actually do it? So I've asked my colleagues to assist here because while I'm presenting on presentation mode, I can't see the chat box. So yeah, maybe let's comment. I hope they have access. Please assist in telling me if the students have access to the chat box or not to comment. Right. Fine. Are we getting comments? Can I have the
Yes.
assistant?
Yeah, yeah.
Okay. I'm gonna stop sharing for now because I don't want the presentation mode because I want to read. Sorry. Please assist with the chat box. What are the journals that they're giving us?
One that says credit insurance debit prepaid expense.
Mm-hmm. Then another.
There's another calculating the amount, 750 Rand divided by 12 times 10. A few of those.
Okay. So yes, we basically correct. So that's what happens because the 2 months is already included. So we're only going to adjust for the prepaid expense as explained earlier. And this is the journal that we're going to pass. So the answer is correct. So we're gonna go back. Technology city. Okay. We're gonna go back to our question. Yes. And then to our question, we're gonna have question number 7. We say the telephone account of 165 for December has not yet been paid. So this is our liability. We still owe the telephone bill. So can I just quickly have someone chat in the group where the journals that they would pass to account for the telephone account? I think if Notipo can quickly text as well so that we move. Because we're only gonna take hands after we went through everything.
Okay, so we have a debit telephone expense credit accrued expense of 165 Rand.
Do we only have one answer?
For now, yes.
Okay. We will work on that, and that is correct. I hope we understand the extent as a kid already, so that it's what we owe the liability. So we're gonna go back to our interesting one, the equipment one. The we're saying that equipment of 2,000 cost was purchased on 1 July 2021. Yes, so that's what we have now. Purchased the equipment for July 1, and then let's combine it with 2.9, which says depreciation must be provided as follows. Vehicles 20% per annum on the diminishing balance method, and equipment 10% per annum on the diminishing balance method. Yeah. So this is an interesting one. Let's have comments on the group or questions, and then we'll take it from there.
So maybe display the adjustments themselves.
The adjustment themselves.
The questions, sorry.
I might not. Can't you see them? I am.
The answer
Unless
is 2.5.
you see 2.5. I'm
Yeah,
on
now you're
2.9.
on. Now you're on the questions.
Okay. Okay. I think it's just the lead response. Okay. For the TikTok glitch, can you all see it now? Okay. Just give it a minute. Are we getting answers?
Okay, so we have debit equipment credit bank of 2,000.
Then the depreciation part, is anyone doing the depreciation part? That's the 2.8, the accounting for what we've purchased. Which should have originally been included there. Do we have anyone attempting depreciation?
Okay, debit depreciation 1,000 Rand. Credit accumulated depreciation 1,000.
We only have one answer.
We have another one on vehicles saying take 40,000 minus 11,200 times 20%.
I think we can take it now. Worth vehicles and equipment, we should remember that vehicles at cost was 40,000 Rand, right? And accumulated depreciation opening balance was 11,200. So we must remember that the depreciation that we're doing that is at diminishing value, meaning as at 1 January, the amount where we're going to calculate, going to say 40,000 minus the 11,200 Rand divided by the years given the accumulation depreciation, which is 20%, because it's diminishing. So we don't just take it at face value, right? That's the method we're going to use. And then for equipment, let's go back. For equipment, they said at cost it was 9,000, and then the accumulated depreciation and 1 January 2001. Don't mind my 2021. I'm not that behind. 9,000 minus 1,017. So we'll have our balance, but then we must also note that we also have we purchased the new equipment which we have to depreciate to apportion it to apportion because it was purchased in July, meaning we're only going to depreciate it for 6 months. So we'll just go through the solution. So this should be explained better. So this is what I was trying to explain without reading the solution. So this is how we got our depreciation. So this is how we did it because it was not a straight line method, it was a diminishing value. So this is how we accounted for our depreciation. So that's what we got. I hope we're all on the same page. If not, we can just write our questions and keep them down. Then we're gonna go back. Just let me know if my screen is showing now because I think it's taking time to. I'm back to the question. So we are on question number 10. Question number 10 says the account of Los Ends Ltd. A data was who owes the entity 200 must be written off as irrecoverable. So how do we write off the data? Going once, going twice. Do we have journals?
Debit credit loss of 200. Credit trade receivables 200.
And that is correct. And the reason behind it is that we have to reduce our trade receivables. So when we reduce trade receivables because it's an asset, we credit it. And then we also we reduce the credit loss. So that's the reason behind it. And then our final question, which will be, it was determined that on 31 December 2001, the accounting of the credit losses should amount to 250. So just to remember that, the reminder that when we closed our books, 31 December 2001, our credit loss was 300. So allowance for credit loss was 300. So I hope we saw it. It's this line, or let me just try to. I wanted to use a pointer, but then technology is not. Let me try this over here. So this is our allowance for credit loss. If you can see it, it's 300. So yeah. So now they think that it was determined that on 31 December 2000, the allowance of credit losses should amount to 250. So yes, we can write our comments and give our thought process there. We have journals, any journals in the chat room?
So we've got a value here, 300 minus 250. Debit allowance for credit losses with 50.
Alrighty. And that is correct because we are reducing the 50 Rand because at the end we had 250, which is 50 Rand less. So I think I'm done. Then if we have any hands, we can take questions. Thank you.
Kutso, if we can maybe go back to the equipment. There's been a few questions on the depreciation on the equipment and vehicles. Maybe we can go back to the calculation for those and just
Okay.
go through it again.
Okay. You will please read the questions for me so that
Okay, so the first question about it, please go back to the equipment solution page.
the solution page.
Yes.
Mhm.
Okay, let's see. That's the comment. Slungile, do you want to ask your question? or put your hand up and we can unmute you. Okay. Okay, I think you should be fine, Slungile, now. To unmute. Slungile, can you try to unmute and ask your question? Okay, there's also another question to Lesile. Okay, maybe my colleagues can also just help me to try and unmute because I'm trying to allow them, but it doesn't seem to be working.
Hi. Can you hear me?
Yes, we can. To Lesile.
Okay, my question is based on the 2004 equipment, the cost price, the cost price on the adjustment. So I can see that it was minus. So I don't understand why it was minus because it's also the cost price.
Hi.
Okay.
Hello.
Hi, Slungile. We can maybe take your question too, and then we can answer both.
Yes, can you please explain everything on the equipment slide because I really didn't understand what was going on there.
Oh, okay.
Okay. Good. So the first question was regarding the other equipment, I think, why we minus the 2,000 from the 9,000 on the cost price. That was to Lesile's question.
Okay. So the initial question was that the equipment part. Oh, I'm trying to move this. Okay. Is that equipment of 2,000 cost was purchased on 1 July 2001, right? And equipment is 10% per annum on the diminishing balance method. So equipment at cost is 9,000. So the 9,000 includes the 2,000. That's how we're taking it out. And then from there, we also, because it's diminishing value, we're also going to take out the accumulated depreciation. Then we have our 5,290, and then we're going to times it by the 10% depreciation that we were given. And then we're going to also, remember we purchased at mid-year. So we're gonna calculate depreciation on the 2,000 rand on the we're going to apportion it to 6 months because it doesn't cover the 12 months. That's the reason why we're doing it. I hope I'm clear. Or you're still not getting me.
Lungile, are you okay now?
Yeah, I think I'm clear. Thank you.
Okay.
There was also another question from Nozipo on the insurance. I'm not sure if she sorted now.
Mm-hmm. She coming in? Nosy? Okay, I'll just explain it again, then I hope then that I'll answer. Nozipho, remember that the insurance is paid for 12 months, but then our year end is 31 December, meaning that we have accounted for prepaid expense. So that's why we went 750 divided by 12 times the 10 months, which is prepaid, because from 1 January to 31 October, it's 10 months. So we are basically accounting for the prepaid expense. That's why we are debiting prepaid expense and crediting our insurance. I hope that's clear. Because if you remember, prepaid expenses are more of an asset, so that's why. And we are reducing our expense for the insurance. I hope I'm clear.
Okay,
Maybe
it
she can
looks fine.
Yeah, okay.
Okay. There's another question about the 2000. Maybe we can go back to the pre-trial balance at the beginning of the question, because the question says, how is the 2000 included in the 9000? And another request to go through the equipment again. So maybe, Kuto, can I maybe just jump in and answer that one?
Yes, you may.
So, okay, so to T. Keswa, the question you asked about the 2000 being included in the 9000. So if you read here, it says pre-adjustment trial balance as at the 31st of December. So this trial balance already is that 9000 that you see for equipment is at the 31st of December. And in the additional information, they say that they bought it on the 1st of July. So that is why the assumption you would make is that the 9000 includes the 2000 because the trial balance is already at December. Does that answer the question? Okay, while we wait for that, let's just see if there's any other hands. Okay, Tima Pudi.
Yes, thank you so much. Yeah, no, I've been scribbling around here and I think I've answered myself. So I'm just going to lower my hands. Thanks, colleagues.
Okay, thank you. Okay, we have a question from SG.
Yes, hello, can you hear me?
Yes, we can.
Yes, thank you. My question is actually on adjustment 11, the last one. I am lost somewhere. I'm trying to understand the relationship in allowance for credit losses and credit losses. So it's just something I'm missing, that I'm not understanding clearly as to the relationship between the two. So can you please explain to me? Thank you.
Hey, Kutso, can you take that one, please?
Trying to move my cursor. Noisy is not. Okay. I can't scroll down. Okay, yeah. So with 11, the question said, it was determined that on 31 December, the allowance for credit loss should amount to 250. So what we actually saying is that pre-adjustment trial balance as at 31 December 2001, it was 300 Rand, right? But then when they review it, it was not supposed to be so. It was supposed to be 250. It was supposed to be 250. So what we basically saying is that credit losses should be reduced by 50 Rand and by 50 Rand, and then we reduce the credit loss. Like the allowance should be reduced by debiting. Remember, credit allowances, you increase them by crediting because they are liabilities. So when you reduce them, you debit, and then you you credit the credit loss. I hope I'm making sense. Because when you do an allowance for credit loss, when you increase it, when you recognize it, you will credit your credit loss and debit your credit, the credit loss. So when you reduce it, it's the inverse of the journal because you are reducing the journal. So I hope I'm making sense. If I'm not, I'll just ask my colleagues to explain it better.
SG, are you okay?
Yes, okay, thank you. I hear what you're saying, but then okay, another part that I forgot to mention, sorry. The allowance for credit losses, I understand that you take it out from the trade receivables control most. And then I thought that maybe since now it's going to be reduced from 300 to 250, the 50 rand, I thought it was going to go back to trade receivables control. That is why I was confused as to why it goes to credit losses. I hope I'm making sense.
I do hear you. It was determined that the allowance for the credit loss should amount to 250. Receivables will increase with that 50 rand because what's this, the T journal on trade receivables. But then I think now it's because we're just only looking at the credit loss. You are correct in what you're saying, that trade receivables will also be impacted, but then now we're just looking at the credit loss side. Am I making sense?
Okay, yes, you are. Thank you. Thank you.
Okay.
Thanks,
Okay,
bye.
thanks, SG. Okay, Dawn, it's our next one. You can unmute.
Good evening. Can you hear me?
Yes.
Yeah. Can you just move to that question for the interest that was not paid for 2 months? I can't remember what question is that anyway.
Question 5. Is that it? That's fine.
Yes. What I understand is that now here the bank was supposed to pay us interest for 2 months, and that money did not come through. So why are we debiting the accrued income and not instead of debiting it, not crediting the vice versa? Why are we not doing vice versa? Because this is the money that we don't have, but we're expecting to get it.
Okay, so because remember, if it's interest income, right? It's the money that we are gonna get. So interest income is a credit. So for us, what happens is that accrued income is an asset account. Hence, we debit the accrued income with 1,000 rand, and
Okay.
then we credit interest on investment because that's the interest that we're supposed to get, which is the income, which will then be a credit.
Okay, so we treat it as an asset account.
Yeah, so accrued income is an asset account. Hence,
Thank
it
you.
increases on the debit side. Are you covered?
Yes, I'm covered. Thanks.
Thanks.
Okay, next we have AN20. AN20, please unmute and ask your question.
Good evening, guys. Can you hear me?
Yes, we can. Evening.
My question is around I think it was a loan that we had to pay 18% biannually, and it said per annum at the end. So I'm a bit behind. I just jotted it down.
Question 2.2. Is this the one?
Yeah. Is this the one that you're asking about? In 20?
Hi guys. Yes, that's the one. Can you hear me?
Yes, we can hear you now. Okay, so with this one, so the one that I just explained now, right, is the interest income that we're supposed to receive. So this one will be vice versa because this is the interest that we're supposed to pay, right? But we have not paid by the end of the year. So it's the interest is payable, interest payable by annual rate. Let me just check what the question was saying. I'm gonna double check. It was 2 point long interest by annual rate. Oh, and
It's 2.2.
yeah, it's 2.2. I see that. Latisha, do you mind helping
Yes.
on this one?
Yes. So I think that your question is about the interest payable biannually. And I think in the wording it says payable biannually. So that's saying that physically we should make the payment to the bank for that loan twice a year. But so that's when the physical payment happens. The 18% is how we calculate the interest rate. So don't when you see the payable biannually, don't let that confuse how you calculate the interest. So the interest will always be calculated using the amount of the loan multiplied by the interest rate, which is the 18%, and for the period. So in this case, it's 3 months that you need to account for from October to December. So the payable biannually is just saying when the physical payment must be made. But the actual recording on your financial records would be for the period you've had the loan. Got the loan on the 1st of October until the 31st of December. So 3 months of interest must be recorded in the financial records for the year ended December 20.1.
Okay, understood. Understood now.
Okay, thanks.
Okay, thank you.
Okay, I see there are no more hands.
I'll just hand it over to you. It's for closure, right? Thank you.
Yeah, so I think if there are no more questions from the group, then I think we will close off the meeting. Thank you for the time this evening. We hope that we've assisted and given you some additional support. And this will, as mentioned before, this will then be shared on my UNISA by the lecturers, the presentation as well as the recording.
Letitia, we have a comment on no exam scope. You can comment on that.
I'm not sure we can comment on the exam scope. I think that's a good answer, Nozipo, entire module. So there will be a few additional revision classes on some of the other learning units coming up. So our requirement would be really to go through all your learning units, join as many revision classes as you can, and prepare by going through the E-tutor questions and the revision exercise that are provided. Okay, I see there's also a request for additional assessments as well. Can we go through previous assessments? I think my recommendations, Lungile, would be, if my other colleagues also agree, would be to reach out to your e-tutors if you want to go through specific questions as part of the assessments in your individual e-tutor groups. And there were already classes that were held by the tutors and the lecturers on the assessments. You can also just go to the website and look for the recordings on those. Okay, then I think if we are good, Mr. Mutlana, we can adjourn the meeting.
No, thanks, colleagues.
Okay, thanks everyone.
Thanks.
Bye.
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 Thank you. Bye-bye.